Alrighty, so we're coming into the lunch hour on the East Coast, so I'm already in the positions I'm going to take for the day and just letting things ride out. So I figured this would be a good time to talk about some intermediate trading concepts. In our basic strategy topics, we pretty much just showed you guys how to trade like a bot. Now, it is crucial to be able to formulate a solid trading strategy with clear entry and exit rules, backtest that strategy to prove out the probabilities, then stick to the plan. Should you decide to actually trade. If a trader can't stick to their plan, over time the probabilities show that it is only a matter of time before they blow up their account. This often happens when somebody begins their trading journey at the start of a strong bull market. There's probably a lot of people watching this who started their trading journey in 2020 into 2021. And you know, money was easy to make during that time. Pretty much anything you bought would rise in value. So money was fast, money was easy. And sadly, a lot of people that got into trading during that time have given up their gains and have even ultimately lost the beginning capital as time has moved on. This could be some of you. I hope that's not the case, but I realize it might be. So in our intermediate concept series, we are going to take things further and discuss some ways that we can better decide which side of the market we should be on, whether long or short, or if perhaps we should just sit things out and wait, looking for clear signs of direction before we enter a trade. So bot style trading has some limitations. If it were that simple to make money, everybody would be running a trading bot and getting rich. We are going to make a few videos on these topics that will help you rise above simple robotic style trading and its limitations. Let's begin this discussion talking about moving averages. Moving averages simply take prior price data, average them out over a period of time, and it gives us a very easy way to gauge if the market is bullish or bearish. Since so many people look at moving averages, they tend to become self-fulfilling prophecies. Now, moving averages are based off of prior market data, so that means there is some lag between when things actually switch direction versus when the moving average is telling you that the market is bullish or bearish. Nevertheless, their simplicity and the fact that so many eyes are on them really makes them hard to ignore. So you've probably noticed this plot. If you are running the Revelator Trading Trend Pro indicator or our basic trend trader, you'll see that there's this plot that runs through price action. And this is what is called a 200 period simple moving average. It takes the past 200 candles and just simply averages them out and then plots that on the chart. Okay, so this is probably the most fundamental, easy to read gauge for traders, looking at the 200 SMA as it's oftentimes called. And if you're trading above the 200 SMA, the market is said to be bullish. If you're trading below, it is said to be bearish. So here we are looking at a daily chart of SPY, which is an ETF that tracks the S&P 500. We are also on the daily time frame. And I've got Trend Pro set on the high frequency setting. So if we go back to the March 2020 lows, all right, so this is pretty recent history. All right, so we see these lows, and you can see that price hit a bottom here and then just took off. And I mean, in the grand scheme of things, hasn't really looked back, but especially between here and here. And you'll see that this rise began before price actually crossed over the 200 SMA. And so again, this is that lag that I'm referring to. So if we kind of zoom into this area, you can see some interesting things here that happen. So we hit this bottom and then bounced back up. So we can see that this bottom occurred the 23rd of March of 2020. And so what happened here is price started to head back toward the 200 SMA, which is this plot here. And you can see as it got closer, you start to see some different pullbacks. And so you can see that this level starts to become significant. And then when we did punch through it, you'll see that the price retraced back down, retested this area. Now this also coincides with the $300 price level. And so we are going to talk about price levels also forming support and resistance, and that just happens to coincide here with the general area of the 200 SMA. So hang on to that idea of various price levels having psychological significance, because they oftentimes do. But we'll discuss that more in other videos. All right, so again, you can see there's some significance here. As we get into that $300 price point, we get into the 200 SMA, we find some resistance, which eventually flips to support, and price starts going up and really doesn't look back too often. Another thing that I'll point out here is interest rates were kind of rising prior to all this. And of course, when the economy goes to crap and everybody's pretty much locked in their homes and not able to work, in order to turn that back around, they had to drop interest rates. They had to actually start adding stimulus to the economy. I'm sure many of you remember that all too well. And of course, when you stimulate the economy successfully, perhaps too successfully, it goes up. And so this is what we would call a bullish phase in the market, where the price is above the 200 SMA. And, if you look at this chart, you can see if you were to long every time that the candles turned from red to gray and just held, this would be buying the dip strategy. And buying the dip was incredibly lucrative, and always is incredibly lucrative during a bull market. All right, but eventually good things come to an end. And so you can see here, there were different factors at play. Interest rates were starting to rise in response to the inflation that was caused by the stimulus. You also had some war. You had some other things just at play here that brought price down. Again, you can see there's kind of a battle for this 200 SMA. And ultimately, the bears had their day in the sun. And so you can see that the SPY began to trade under its 200 SMA. Again, you can see here, it actually functioned as resistance. It strongly reacted to that level. You could also argue it coincided with the 430. So you got two things at once, giving rise to that idea of resistance being here. There's also some other fundamentals at play. So oftentimes you'll have some pullbacks in September, not always, but often. And so these are fundamentals that we'll talk about in more detail in other videos. Okay, so we can see that the 200 SMA, a lot of people got wrecked here. And they gave up not only all of the gains that they made here, but then they started drawing into their capital. They not just lost their gains, but they lost their capital. And the reason for that is they just didn't have a trading plan. They thought they were geniuses here. Everything you did here made money, unless you were one of the few people that decided, to short and, refused to believe that, we were going to pull out of this. Those people got wrecked here. And then they probably flipped long here and got further wrecked if they still had capital. Okay, so this is where the perma-bulls oftentimes got wrecked if they didn't have risk management and didn't have some basic self-awareness that, hey, what was working here isn't working here. I should either flip short or I should sit out of the market. All right, so for all of its limitations, the 200 SMA really, could have spared a lot of people a lot of grief had they just used that very simple metric. Okay, so we could say that the market is bullish when it trades above the 200 SMA, and oftentimes it's an uptrend. We could say that the market is bearish when it trades below the 200 SMA, which we could also say is a downtrend. There is a more technical definition for a uptrend and a downtrend. An uptrend is just simply where you are making higher highs as well as higher lows. And on the flip side, when you have a downtrend, you are making lower highs and lower lows. And so at this point, once you've made some lower lows, we tried to make a higher high, but it wasn't higher than this one. At this point, if you haven't realized that we're at the beginning of a bear market, you could have if you would have just kept that simple definition. I mean, if you would have waited for the news to tell you you were in a bull market or a bear market, they're not saying that until down here. Okay, so again, just real simple definitions. Looking at something just as simple as a 200 SMA, looking at that definition of, either higher highs and higher lows or lower highs and lower lows for the downtrend. Really simple things like that can give you an edge as a trader. And so many traders choose to only long above the 200 SMA or only long as higher highs and higher lows are being made. And of course, the reverse is true for the short side of things. Many traders will choose to only short below the 200 SMA, or they'll be looking for, this pattern of higher highs and higher lows to be broken. And so that would be another indication to short. All right. So that really, I think, covers everything I want to cover in this video. I don't want to make these concepts too long and drawn out. Instead, what I want to do is actually just kind of leave you guys with a homework assignment. Okay, so go to SPY, look at it on the daily, the weekly, the monthly. You'll find times like this where the 200 SMA is only visible in part of the chart. For some assets, it might not be available at all. And that's because it needs at least 200 candles before it can start calculating an average of 200 candles. And so that's why you don't see that appearing until on the monthly chart here until after 2009. So for really new assets, you might have to flip to much smaller time frames to see a 200 SMA. So the first homework assignment I would give you is to, number one, look at SPY daily, weekly, monthly, and look at the relationship of the price versus its relationship to the 200 SMA. The other thing that I want you to do there is look for patterns of, higher lows and higher highs. And on the flip side of things, I want you to look for patterns of lower highs and lower lows. So identify some bull markets, some bear markets, or if you just want to call them bull trends, bear trends. We could split hairs here. There's really no point in doing that, though. Okay, so look for those sorts of things. Another thing I'd encourage you to do is to look back through history here. There's a lot of data here. And consider, what was going on? What led to this? What led to this? What ultimately pulled us out of some of these downtrends? And I think you will see that there are fundamental reasons for why the market sometimes moves in a particular direction, why it hits its head and then goes down, why it hits a bottom and goes up. And then beyond that, it's not a bad idea to use the bar replay. Squish in that chart to where you can't really see a trend, and then go way back, and then hit a bar replay, and then just come in there and make some predictions based off of the 200 SMA, based off of what you know about the technical definition of an uptrend and the technical definition of a downtrend, and see how you do. Maybe employ that into some of your back testing and see if you can't improve your win rate with just this really simple metric of either the 200 SMA or by just simply looking for higher highs and higher lows or lower highs and lower lows. All right, so if you have any questions after watching this video, be sure to watch our other videos. Read our knowledge base articles. I will oftentimes do a knowledge base article that goes deeper than I do into the videos, and those will be found in the video description. So be sure to read those. And then also feel free to reach out to us if you need anything else further explained. If we have time, we'll be happy to help. Of course, we always have time for our paid members. We have some time for those who've signed up for our free subscription levels. So definitely consider that free subscription level. It will give you some priority versus somebody who just comes in off the street with some questions. It gives us some common ground to where I can say, hey, load up, our indicator and let's talk. All right, so I hope you've found this video useful, and I hope you take it seriously, do some of these homework assignments that I've suggested, and see what you can learn, and we'll see you in the next video.